Hello, good morning. So I'll start today's webinar. Today we will be presenting on CapitaLand Mall Trust, Frasers Centrepoint Trust, JP Morgan sets technical outlook, as well as US and China weekly. Okay, so for CMT, they announced their results last week. Overall, we noticed that gross revenue was up 10.6%, but this was mainly due to the consolidation of Westgate, which CMT acquired the remainder 70% of last quarter. And also contributing to the gross increase in gross revenue was 3 days of trading revenue from the newly reopened Funan. On a normalized basis, we actually saw revenue increase by 1.2%. So similarly, distributable income was also lifted thanks to the acquisition of the 70% stake in Westgate and the opening of Funan. Operationally, CMT recorded better rental reversions, although they also noted weaker occupancy. So rental reversions for 2Q was 1.8% over the initial signing rents. And for comparison, in 1Q, the rental reversions was 1.2%. Another positive is that Funan did not cannibalize Raffles City Shopping Centre. This is due to different tenant mix at Funan. On the negative side, as mentioned, portfolio occupancy fell. It fell by 50 basis points. So now at 2Q, occupancy is 98.3%. This was due to fall of occupancy in Clarke Quay as well as Bedok Mall. Due to the softer retail sector outlook, CMT also noted weaker retail sales despite an improvement in shopper traffic. So tenant sales actually fell by 0.9% for the first half of 2019. This is slightly worse off than the tenant sales for 1Q19, which fell by 0.5%. So it's a 40 basis points deterioration. So we were comforted that actually tenant sales per square foot per month on by trade sectors actually increased by 1.2% year on year, and the top 5 categories contributed more than 70% of gross rental income were the ones that registered growth in tenant sales. Also, an update on the situation with Jewel and how it has affected the malls in the east side. Tampines and Bedok Mall, they were slightly cannibalized by Jewel. As of 3 months after the opening of Jewel, the tenant sales for Tampines and Bedok Mall have settled at about a -5% and -2% respectively. Looking forward, we expect Funan that has 30% of new tenants, 30% of tenants that are new to market. They are local brands, so we actually expect a little bit more risk sharing. That means these new to market tenants will actually negotiate for a lower base rent and a higher variable percentage of gross turnover. So we maintain our neutral for CapitaLand Mall Trust with a higher TP of 2.68%. Moving on to Frasers Centrepoint Trust, we actually upgraded FCT to accumulate and with a higher target price of $2.77. Operationally, they did quite well. Gross revenue was up by 1.6%. This was mainly due to improvements in revenue from North Point, North Wing, and as well as Changi City Point. So this is despite the better performance is despite softer retail sector outlook. Shopper traffic was up 6.1%, mainly due to higher traffic at North Point and UT Point. Tenant sales per square foot also grew by 2.9% year on year for the 2 months period ending May 2019. This led revenue to improve by 1.6% as previously mentioned, with all malls recording higher revenue except for CWP, Causeway Point, which was undergoing AEI for their underway link. Unlike CMT, FCT actually recognized better portfolio occupancy, which improved 80 basis points and now stands at 96.8%, as well as positive rental reversions of 3.1%. This is on the negative side. This is the effect of the acquisition of Waterway Point, which FCT acquired a 33.3% stake in recently, and post acquisition gearing would actually rise to 32%. There will be a lower interest coverage ratio of 4.5 times. So in comparison to the financial year ended 2018, interest coverage, which was 5.6 times. A slightly higher borrowing cost of 2.7%, up from 2.6%. This is due to higher percentage of borrowings on fixed cost. So why we like FCT? There are 4 reasons. First of all, FCT still has pipeline assets from their sponsor, Fraser Property. So they still have about 4 assets in the pipeline that they can potentially acquire, as well as PGIM. PGIM is a private fund in which Fraser Centrepoint Trust, along with their sponsor, Fraser Property Limited, has acquired quite a significant stake in. So they started acquiring the stake in PGIM in April this year. And since then, their stake has now increased to about 75%. And what this private fund does is they basically own fringe retail malls that are very similar to the kind of assets that FCT owns in their own portfolio. So, but unlike FCT, because it's a private fund, they do not enjoy the tax transparency treatment, and their earnings are subject to tax. So the opportunity here is for Fraser Centrepoint to actually acquire some of the PGIM assets onto their portfolio, and hence their earnings will benefit from the immediate tax savings. So that is the first reason. That's the second reason. The third reason is the repositioning of Causeway Point. It is FCT's largest asset, and it stands to gain tremendously from the transformation of the Woodlands Regional Centre. So it will be like the anchor mall in the north. Also, Waterway Point, which was recently acquired, is going to benefit from being the dominant mall, as there's no retail supply coming on in the area. The last reason why we are a bit more bullish on Fraser Centrepoint Trust is the improvement in rents, as specifically fringe rentals. As you can see from the figure 2, the fringe rents has actually outperformed the central rents, and this is also evident by the improvement in their the positive rental reversions that FCT has managed to clock at 3.1% this quarter. So just reiterate our call. It's an accumulate now. It was upgraded, and the target price is $2.77. Moving on to Edmund.
Thank you, Natalie. Warren, I'm replacing Emma for now, as he's out for a moment. So for today, we'll share US weekly. Okay, so for sector performance, as we can see, the S&P 500 is currently down, but year-to-date return, we are still at 21.2%. Most of the sectors, financials, healthcare, and materials and industrials are doing well, and as well as real estate. The only downside is the utilities. So move on, we'll talk about 2 drivers for JP Morgan growth. First, the 2 drivers are mainly the consumer and the mortgage loan growth and stabilizing deposit repricing. As such, we have a technical buy rating for JP Morgan, and because we are encouraged by consumer loan growth, and also the P ratio of 12.1, which is below the historical average. Based on analysis, we think that JPM is reasonably priced compared to its peers with other major banks in the US. So moving on, for the consumer loan growth section, the University of Michigan consumer expectation is up, and credit card loans were up 8% year-on-year, driven by low unemployment, labor, and wage growth. Consumer spending remains solid, consistent with the rise on core retail sales, 7.5% year-on-year, and a rise for Q2. For deposit repricing, low retail deposit betas and fastest wholesale deposit repricing downwards. As you can see from the chart, the prime rate is actually higher than the 3-month and 6-month and the MMA. So for mortgage loan growth, low mortgage interest rate drives much more mortgage sales and new home inventory to support those sales. So both the real estate and the mortgage loan are in tie with each other. And looking at the new home sales and the chart over here, you can see a steady rise and 14% year-on-year in Q2, mainly due to lower, as I said, mainly due to lower mortgage interest rate. The rebound in new home sales in June illustrate that healthy new home inventory sales will support sales. So for carry on, these are all the earning charts that we have. So these are all the major industrials and utility stocks and pharmaceutical stocks that we have. So moving on. Okay, so this is a webinar. So if you're interested, please take a look. So now I move on to Jieyuan for the China brokerage sector.
Thanks, Warren. I will give an update on the China brokerage sectors. We are overweight on the China brokerage sectors mainly because of the two reasons. One is the policy spot. The other reason is the beginnings in the investment income in the first quarter. For the policy side, we are believe government current policies as stands to support for the recovery of the brokerage industries in two ways. First is by encouraging directive financings like establishment of the Kershaw board and encourage the companies to issue the bond financings. The policies to give the brokerage companies the more business. The second thing we are thinking, because on the February 2019, CSRCs are plans to do the tax and fee reductions for the brokerage industries. We expect the list policies will come in the third quarters. For the Kershaw board, we compare the standard listing standards and the pricing method of the Kershaw board and the living board. We noticed that the Kershaw board has the following advantage. For the first thing is the less regulations disruption for the IPO process. For the Kershaw board is primarily approved by the Shanghai Exchange, unlike the main board is primarily approved by the regulations institutions. Secondly, is a different for the Kershaw board. There is the 5 different listing standards. It will provide the more security financings and expanding the list of the companies who can list on the Kershaw board. The third thing is the Kershaw board removed the 23 times of the PE limited. Is the more based on the market inquiries. So we are thinking it will give the companies the more favorable valuations. This is the list of the 25 stocks that currently list on the Kershaw board, and there's the P ratios at the IPO price. For the Kershaw board, there's the P ratios are higher than the average of the main board, average P ratios of the main board. The second reason we are positive on the brokerage industries is because the latest 2019 Q1 statistic shows the brokerage incomes, especially for the investment incomes, are increasing rapidly because of the markets gaining over 20% in the first quarters. The investment incomes increased over the 200% year on years. Which is the 3 years the highest. Overall, we are overweight on the Chinese brokerage sectors, and we are thinking because of the government policy support and the first quarter's investment incomes will shelter the sectors from the second quarter's market volatility. And this is the list of the ETFs that have exposures for the Chinese brokerage sectors. For the stock performance last week, because the fund attentions already drive from the Kershaw board to the main board, there is a slightly up rebound for the main board. The CSI 300 up about 1.32% last week, and we are seeing that especially for the financial sectors and the communication sectors are gaining the most performance sectors. We are still positive on the financial sectors, the performance, especially for the banking and the brokerage sectors. And this is the list of upcoming earning results. On this week, we are waiting for the Baidu and iQIYI. I will pass my time to the Wei for the technical outlook.
Hi, thank you, Mike. So let's move on for sets. So for sets, based on the Elliott wave count, we are currently on the on the primary wave, on the third wave, potentially. So because for the wave 2, we have to see the intermediate wave 4 is it being invalidated because for the placement over here. But let's move on. So based on the wave analysis, the current wave analysis suggests that the stock is heading the fourth wave correction. Over here, like what I mentioned, the prior third wave is usually strong as a past 3 to 3.6% of Fibonacci wave 1 to 2. Okay, 1 and 2 over here. So believe that the correction might be therefore we believe that the correction might be complex with prolonged period. So next, head and shoulder formation over here also suggests that the price may fall further downwards, but wave analysis suggests that that the wave B, the right shoulder currently, there might be a potential upside for wave B over here. So if should happen, the complex flat may occur for a prolonged period of time between between $4.50 to $6. However, should price continue to move lower, then the expectation is that current right shoulder is the expected B wave. Yes, this is the right shoulder, and we are currently towards C wave. Is either here or here. So based on the wave analysis, there are two prominent reversal areas spotted. So first is at the $4 region, and the next one is at the $3.10 to $3 region. However, it should price retrace all the way for the wave 4 all the way here, then the primary wave count of the wave 1 will be invalidated. So because the rule for LA wave is that in order for wave 4 should not exceed the high of the wave 1. And therefore, if should wave 4 exceeded, so there will be a possibility that this whole wave count will be invalidated, and this whole wave will be from the low 0.93 to 5.8 is the wave 1 instead. Okay, so is there any questions before we end the meeting? Hi, thank you for Galaxy Asset. The technical trade recommendation is just a general view of the LA wave. So for this, we are looking at around 6 months to 1 year for this period of time. So for the next period, there will be might be a prolonged. First, there might be a prolonged complex correction, and then followed by a fall towards the wave 4 target area. Just now. Yep, thank you. Also, this week there's no Singapore Weekly by Paul. Thank you.
Hi, so I have a question about the cannibalization of Tampines and Bedok Mall by Jewel. Okay, so this question was actually posed to the CEO of CMT as well, and his response was it could go on for a while more. First of all, Jewel has a very strong trade offering in terms of like the F&B offering is very strong. While the hype has sort of died down in the first few weeks, the impact to Tampines and Bedok Mall was actually more severe, and it has settled down. This is after 3 months, but the thing is, while some the CEO's observation was that while some shoppers will want to go when the mall first opened and join in the hype, there are some other shoppers that will prefer to go once it has settled down. Once the mall Jewel is not so busy. So he said that we have to wait and see. But for now, we can assume that this cannibalization of about in the low single digits will prevail for maybe the next two quarters. As for the DBS question on DBS, sorry to say that our banking analyst is actually still on the call, so we'll not be able to give you an update on it. Hi, so the question on do I foresee the shopper traffic to worsen or stabilize? I think that it will stabilize, and probably it will settle at the low single digits. So currently it's about 5% and 2%. I think it will stay around the 2% for both the malls. We also have a question on the Fed rate cut for the SG stock market. I can only speak for the REITs side. So yes, we were expecting a very dovish stance early this year, and I think the stock market has actually priced it in already. So that explains the very high REIT prices. So in terms of whether or not any other Fed rate cuts will affect the share price for REITs, we think that it's actually already all priced in, so it will not move the share price for REITs anymore. Probably what is still to be, as in we currently feel that there is more downside risk than upside risk in terms of the Fed rate. So if the rate is not if the rate cut is not as sharp as once thought, the correction will actually be negative. For the potential higher gearing proposal, yes, it is actually positive for the REITs. It just allows them more operational flexibility to actually, instead of having to keep raising equity, they can actually utilize more of their gearing, and that is actually good for the REITs. But as previously mentioned, actually most of the REITs are quite expensive at this moment, with a lot of them trading close to the 2 standard deviations of price to NAV. But we do have selective preferences. For example, Frasers, which I mentioned, that for 4 reasons why we feel that the investor should actually take a position in Frasers, Centrepoint. For the question about why do I not think that Funan would cannibalize shopper traffic at Raffles City, actually this was observed. This is based on the observations on the ground after Funan has opened. That it actually did not cannibalize the shopper traffic. In fact, the footfall at Raffles City actually increased because Funan is located. It's more of like a destination shopping, meaning that it's not very close to the MRT. You still have to make your way from the MRT to Funan. So I think because of this, there was a spillover effect for Raffles City, and tenant sales were actually better for Raffles City. Also, for Raffles City, the tenant mix is more towards luxury shopping, and the luxury stores in Raffles City, they are actually doing quite well. And does it imply that Funan has unattractive tenants? I think Funan is playing more towards the millennial trends. So most of their like for example, the 30% of new to market tenants, they all focus on, they have a story to tell and a different angle which actually appeals to millennials. So it's not that they have unattractive tenants. These tenants are more testing their demand, the demand for their products. For the question on whether or not the enlarged unit base poses further risk for the DPU, our target price actually factors in the enlarged share base already. So I think this time around DPUs for the financial quarter ended 2019, which is on September, the next quarter, the increase in DPU will not be so significant, but more of the increase in DPU will be seen in the next year.
For the questions where there will be discussions on the US and the China's, I think in the perspectives of the trade wars, I think for now China's and the US side are starting to negotiations, and US side to remove the additional tariffs on the US goods export to China's on July 21st. So we are thinking the negotiation is the proceed the step by steps, and for now we don't have any first news and informations. If there's no more questions, we'll end today's webinar. Thank you.